really excited to be here talking today with Brent. Thank you for being here, really good. So I think that a lot of people will be familiar with your dollar milkshake concept. And I say that with confidence because I watched a panel yesterday where you weren't even there and everybody was talking about it. But I know there are also some misconceptions. So I thought we could start with just a quick overview for people who may not be aware what they should know about it.
Sure. So I won't go into too much detail, but there's several videos on YouTube and several different podcasting networks that talks about the dollar milkshake theory. I actually presented that theory for the first time at this conference, I think it was either 2018 or 19, and it's really a framework for how I see a sovereign debt and currency crisis playing out. The reason I think we're going to have a sovereign debt and currency crisis is because global debt is now over $300 trillion. A lot of people know that the United States owes $35 trillion. A lot of people don't realize that the rest of the world owes $35 trillion in US dollars. So they owe it in a currency that they can't print. So global debt is a huge problem. And I essentially think that when we get into a global debt and currency crisis, the dollar will perform better than its competing currencies, and it will go up a lot versus the other competing currencies, and that will then kind of turbocharge this crisis.
Okay, very, very succinct overview. And so you mentioned this, you brought this up, you introduced it here in 2018. And I think certainly in that time and in recent years especially, people have been hearing about the huge debt problem. And I'm sure many people are wondering, why hasn't that hit the fan yet? So maybe we get your thoughts on that.
Yeah, well, I think part of it is, and it's funny, when COVID hit right after I was at this conference in 2020 going home. But anyway, when COVID hit, I thought that was probably going to be the catalyst that would, kick off the crisis. But actually, in hindsight, I'll admit that I got it wrong because the government reaction from around the world was pretty much in unison and coordinated, and everybody did this. And they, to their credit, they got everything under control. They printed the money, they did the bailouts, they did the stimulus, and they got everything back on track, and markets moved higher. And as long as the market's moving higher and it's expanding, it can continue. The problem is when it stops expanding and it starts to contract, that's when they have trouble. What I would say now is that post-2020, the world isn't cooperating the same way anymore. There's much more division, both political, geopolitical, both internal. In several different countries have internal strife. If we get into some other crisis, I don't think that there will be as a coordinated response. And if it is coordinated, it'll be maybe coordinated regionally or strategically. I don't think it will be a globally coordinated event. And I think that in itself will cause problems.
Right. And, I mentioned I've been hearing a lot about your dollar milkshake concept here. And it seems like a lot of people understand it and agree with it. One question, and I'm sure you've heard this before, but I think it's worth going into. So there's demand for US dollars. People seem to wonder, what about the treasuries, though?
Yeah, so this is a little bit of the misconception, too, is that I think a lot of people believe that in the dollar milkshake theory, treasuries rise in value and the yields go negative. That could happen. I really don't know. But a sovereign debt crisis, and it's not just... It would be global, but that would also include the United States. I don't think the U.S. goes through a crisis without getting hurt. Actually, I think it will get hurt very badly. I just think it will get hurt less than most other markets. But a sovereign debt crisis is essentially when interest rates rise because nobody wants to buy the sovereign bonds anymore. So what we could have is a situation where interest rates are rising in the United States for all the reasons they've been rising the last couple of years. But what I don't think will happen is that the world will reject buying U.S. treasuries, but continue buying Italian treasuries or Chinese treasuries or Swedish treasuries or South African treasuries. If the U.S. gets into a situation where it cannot fund itself due to sovereign bond concerns, we're not going to have a situation where the rest of the world can, fund themselves by selling their sovereign bonds. I'm not sure about anything, but that's pretty close.
Right, and you mentioned you're not sure about a lot of things. There's a lot of uncertainty going around. Nevertheless, we are going to look at 2024 and hoping to get your thoughts on what you see coming in terms of the Fed that's on everybody's mind right now, interest rates, inflation. Is there anything we can say with certainty about this year?
Well, there's nothing we can say with certainty. I will say that I've been doing, this is my 25th year of doing this in this business. And so I've seen several crises, several booms, busts, inflation, deflation, you name it, wars, but I've never been more uncertain than I am right now. And so in an uncertain environment, I just kind of slow down and be very careful. The one thing I think is very unlikely is I don't think we get a situation where the Fed cuts interest rates 6 or 7 times and the market's at an all-time high. In other words, the market's at an all-time high right now. They've talked about cutting interest rates 2 or 3 times. The market seems to think this means 6 or 7 times, and the market has kind of front-run these now expected 6 or 7 cuts, and so it's at its high. The only way I think that we get 6 or 7 cuts is if the Fed is reacting to some severe pain in the market, and if there's severe pain in the market, then the market's not at its all-time high. So that's the disconnect for me, is that it seems to me that there are people that think that the market's just going to keep going up and to the right, and they're just going to cut into the market going up and to the right. Now, that I do not think is going to happen.
Right. And so you mentioned this is what you're doing right now. You're being very careful. And there's so much uncertainty. And when we're talking getting prepared for this question, you kind of said you don't know what's coming, so you need to prepare for anything, which sounds like a really big task. So what can you say about that?
Yeah, so, when I was probably 25 years ago or even 15 years ago when I was younger in this business, I used to always try to be right. And I always tried to figure out what was going to be the thing. And I think the older that I get, the more I realize that I don't know a whole lot, and neither does anybody else. And nobody knows for sure about anything. So rather than trying to be right about everything, I just try to be prepared for anything. And so what I mean by that is we have equities. We've owned equities for years. But I think in the short term, equities are probably going to go down. And so we have hedges against those. We own fixed income, but we don't have very long duration, less than 5 years. And we have a lot of T-bills because you get 5% for just sitting in cash right now. We own gold because I think in the long term, gold's going to win. And, there's no reason not to have the asset that's performed as good as anything over the last 5,000 years. But I think the most important thing that I would say is people underestimate the value of having cash or dry powder. And they'll say, especially in an inflationary environment, that's a drag on my overall purchasing power and it's a drag on my overall portfolio. And there is some truth to that, but in my opinion, the drag is not so heavy that it warrants not having it because for a couple of reasons. Number one, you can actually sit in cash now and get a return. Like 4 or 5% is not horrible. I can remember coming to this conference 5 years ago, and one of the big complaints was you had to go out 10 years and buy a junk bond to get 5% yield. Now you get a 2-month treasury and you get 5%. So that has dramatically shifted. So the drag for sitting in cash is very low, if at all. The other thing is that if you get into some kind of a liquidating market that just comes out of nowhere and you're not ready for it, if you're all in and you don't have cash, then you're going to be stressed. And you're probably going to be a seller because you'll want some cash. But if you already have cash, you won't have to be a seller necessarily, and you're going to be in a better mental state. And if you're in a better mental state and you're not stressed, you're going to think more clearly. And if you think more clearly, then you're going to make better decisions. And I don't think you can really measure that. So when I say be careful, have some downside protection. I can't tell you exactly how to do it because I don't know everybody's portfolio, but have something that you're not just flying blind.
Right. And you've also talked about the importance of being emotionally detached. Don't put emotion into what you're doing. So maybe you can share some thoughts on that because I think that's very hard.
Yeah, this is another big mistake that I used to make, and I fully admit. I mean, all this, I think Rick Rule's talking at the same time, so I'm kind of surprised anybody's here. But Rick has the best line that I've ever heard at a conference. He said, "Use my scar tissue to protect your portfolio." And so I just love that. And, so I've made millions of mistakes. One of the biggest mistakes that I used to make, and it took me a long time to realize this, is that I was investing based on what I wanted to see happen rather than what was actually going to happen. And I would put my own personal morals and my own personal desires into my clients' portfolios. But actually, when I stepped back, I realized that that's actually the wrong thing to do. Potentially, I could ask my clients what their morals are and put their morals in their portfolio. But as a fiduciary of their money, my job is to make their money grow. It's not necessarily to become a financial justice warrior where I put my desires into their portfolio. And that actually helped a lot because then I just started analyzing everything as a neutral observer. And it's amazing the clarity you get when you take the emotion out of investing. Like I'll give you an example, like gold. Gold is the most emotional asset in the world, other than maybe Bitcoin. And people have a hard time thinking rationally about it. So I own gold. I think it's going to do really well, but it can go down. I know people don't want to hear that, but it can go down. And so, and the other thing is, just because you think something might go down doesn't mean you have to sell it. Like, I think it's very possible gold goes down this year. But I know it's important, so I own it, even though it might go down. So I think I guess the biggest lesson, the biggest thing I would say is to take out what you want to see happen and just figure out what's actually going to happen, or try your best to figure out what's actually going to happen. The milkshake there, this is a perfect example. Like, I don't like the current monetary system, but I understand it. And it took me a long time to figure it out, but I understand how it works. And I don't necessarily want the dollar to go higher. I don't necessarily want gold to go higher. I don't want to be on a dollar standard. I would in many ways prefer to be on a gold standard, but we're not. That's not the way the world works. And if you invest based on the fact that you want there to be a gold standard and there's not, it's going to show up as problems. And I can guarantee you that will translate into problems in your portfolio. And so, my theory is part of the reason that I was not convinced, but fairly certain that it would play out was because I hated the answer. I hated when I came to the conclusion, I was depressed. Yeah. Anyway.
Wow. Okay.
Yeah.
Very good answer. And so we've got to pull out more of your thoughts on gold. You mentioned in 2024, maybe gold going down a little bit, but of course it looks like you're quite bullish longer term. So maybe we can look at the short term as well as the big picture.
Yeah. So again, I'll say, I don't know what's going to happen with gold this year. If we get the 7 rate cuts, then it's probably going higher. I think that's unlikely. So I think gold is kind of range bound until we get clarification on which way rates are going. I think it's very possible. Again, if we get into another mini crisis or whatever you want to call it, even a big crisis, I think gold falls initially, especially if we get margin calls. I mean, Grant Williams just gave a great presentation, and he showed during the Great Depression, during in the late 70s, again in the 2000, again in 2008, like in the initial stages of the crisis, gold falls because it gets liquidated to pay the margin calls. But it recovers faster than anything, and then it usually runs on the new heights. And so I would expect that would be the same case this time as well. So my long term, I've always said that gold will go to $5,000. I don't think it's going to happen this year, but I could easily see it there in 5 or 10 years.
And I think because we're at this conference, we got to touch on the gold stocks as well.
Yep.
So there's a lot of them out on the floor here. Clearly, you see gold as an important portfolio component, but where do you stand on the gold stocks?
I'm less bullish on gold miners, and I know that many people don't like to hear that. I'm not against it. I just don't think, I've come to this conference for probably 10 years now, and I will talk to people, and they'll come up to me and talk to me about their portfolio, and they will have 40% of their portfolio in gold miners or 60% of their portfolio in gold, and I just think that's the wrong way to go about it. If you look at GDX, which is a index of gold miners, if you look at GDXJ, if you look at the Philadelphia Gold Bugs Index, which I think goes back to 1984, so one of them goes back like 12 years, one of them goes back 15, one of them goes back almost 40 years. They are all negative since inception. Or maybe they're up like 1 or 2%. But so I guess my point is, a lot of times people will say, I own gold miners for the long term. I don't think you should own gold miners for the long term. I think you should buy them, and when they go up 20 or 30%, you sell them. And when they pull back, you buy them. And so I think you trade. To me, you buy and hold gold, but you trade gold miners. And I think a lot of people buy and hold gold miners. So I think they have it wrong in their portfolio.
Right. And, one of the hot topic conversations I keep having here is, when does that disconnect correct itself between gold and the gold stocks? Did you have any thoughts?
Well, I think when gold finally breaks out, then that will be the correction. The other thing I'd say is I don't have a problem with people buying and holding gold stocks in their portfolio, as long as it's not 60% of their portfolio. Like, again, I remember in 2020 talking to Amir Adani, and man, he was depressed. Uranium had just gone sideways forever, and he kept giving the same presentation. It's just matter of time. And look, he's right. Now the stock's gone from, $3 to 30 or whatever it is. And, he was right, but he had to wait a long time. And so, sometimes you have to wait a long time for those big hockey stick payoffs. So I totally understand owning gold stocks. I just don't think it should be your entire portfolio.
Very, very fair. I agree. And on the note of gold stocks, I want to bring up a point that you made before we were doing this presentation offline. I found it very interesting. So we're talking about de-dollarization, which is another big theme at this conference, and kind of in the space in general. One of the points you made is that, these gold companies, they're selling their gold, and what are they selling it in? Dollars. So maybe you could talk about that point.
Yeah, I think this whole de-dollarization movement is legitimate in theory and not legitimate in action. And so what I mean by that is people are trying to de-dollarize. They would love to de-dollarize, but it's really, really hard to do. And it's easy to put out a headline, but if you think that the world is de-dollarizing, well, let's just get a show of hands. Who believes de-dollarization is real? Few people. Okay. Who believes that if we do de-dollarize, gold will be part of the solution? Okay, a few more people. Okay. So if we're going to de-dollarize and gold's going to be part of the solution, I would think that the executives that are the closest to gold would be part of this movement and part of this plan to now use gold in the monetary system. So I would recommend that all of you go to all your gold mining companies out here and ask the executives what their plan is to sell gold in something other than dollars, and see if they have an answer for you. And if they don't, maybe that's a signal.
Very interesting and worth thinking about. So great to hear about how gold performs in the scenario that you see coming, but I'm curious about other commodities, many commodities out there, and what else do you see sticking out, doing well?
Well, so the one place in commodities that I've been invested in for the last 6 months has been horrible. I've been in wheat, corn, and soybeans. So I actually think there's a chance that agricultural commodities will do very well in the years ahead, partly because of demographics, partly because of weather patterns and El Nino, partly because of sanctions and geopolitical concerns. So I think there's a possibility that, the grains and kind of the soft commodities do extremely well. And so I would, now that they're all beat up, it's probably a good time to go take a look at those. The industrial commodities, again, I think it's a crapshoot, because I think right now we're probably due for some kind of a pullback in the overall markets. And so, but if we get that, then buying the dip would make sense.
Okay.
Because there will be if we get a crisis, if we get a pull down in the markets, the central banks will react. They will come back with more stimulus or liquidity.
Any thoughts on energy?
I think energy is pretty interesting. I think, some people have these price targets for, nat gas at $200 and oil at $300. I can see it, but again, I think this year is so uncertain to me. Again, it's hard for me to make, just because I think it can go either way. But I would expect in the years ahead that energy will be priced much higher than it is today.
Yes, I'm so sorry to keep trying to make you have predictions that are concrete about a year that's going to be maybe.
I'm sorry, I'm very uncertain this year.
Very fair enough. So we've got a couple of minutes left. I'll put it back to you and just see if there's any final thoughts that you want to leave the audience with in this time of uncertainty.
Again, I think the biggest thing that I can impart to people is try to be as unemotional as possible. I know everybody says that, and I know everybody knows that, but to actually do it is really hard. And I would caution you against trying to be right all the time. I gave up trying to be right all the time and just trying to be prepared all the time. Now, if you see an opportunity and you have great conviction, I have full respect for anybody who makes a big bet on their convictions. And if it pays off, I will, say great job. I'm just saying there's a lot of dead heroes out there who, made a big bet and it didn't work out. So really know what you're getting into. If you've got, 50, 60, 70% of your portfolio in one asset, you better be sure, right?
Right, and this is kind of a theme that I have been seeing coming up a lot, is people needing to think for themselves, and it is great if you come and listen to people like you, but you do have to start thinking for yourself. Yeah, that's another thing is, I used to, like everybody, Stanley Druckenmiller would say something, and that was my opinion, and Jim Rogers would say something, and that was my opinion, and Rick Rule would say something, and that was my opinion. And it's not that, listen, these guys are geniuses. It's not that you shouldn't listen to them, but then you can't just take their opinion and go run with it. You got to think about it yourself, because, again, I'll use this de-dollarization thing as a perfect example. I mean, there was headline after headline after headline over the last couple of years, but there hasn't really, if you actually look at the facts, there hasn't been that much progress made. Now, I actually think it might be great if there was progress made, but there actually hasn't been. And so, again, if you're stripping out the emotion and if you're looking at the fact versus the headline, there hasn't been a lot made. The other thing is, this idea that the BRICS are all like
going to get together and, issue this new currency. They've been saying that every year, literally every year since it was founded in 2009. They put out some headline leading up to the meeting that this is the year, and then every year Lucy pulls the football away, right? And so, again, don't just look at the headline, look what they actually do. And the other thing is all of these politicians, all of the big business leaders, in all of these other countries, they all have offshore hidden bank accounts. And they're not stuffed with rubles and they're not stuffed with yuan. They're stuffed with dollars. So if they really believed the dollar was trash, why do they have offshore accounts in dollars? So it's a relative game, and I would encourage people to look at investments as a relative game rather than an absolute one.
Okay, very good. I think that's where we have to wrap it up. So thank you very much.
Thank you. Thank you, everybody.